Imagine paying a contractor, like a 2% management fee, every single year to renovate a house they haven't even started building yet.
Right. Just for doing absolutely nothing.
Exactly. I mean, they haven't swung a hammer, they haven't bought a single plank of wood, but they're charging you tens of thousands of dollars annually just for the privilege of, holding your place in line.
Yeah, if a contractor pulled that on you, you would immediately call it fraud.
Out of second thought. But when Wall Street does it with the retirement savings of everyday public school teachers, well, it is somehow considered business as usual.
Which is just wild to think about.
It really is. So today, we are bypassing the usual pleasantries to look at what happens when the people actually funding these systems decide they've, had enough.
Yeah, a real turning point.
We're looking at a grassroots movement, specifically a Facebook group of 2,797 Minnesota public school teachers who just completely lost trust in the opacity of their retirement system.
And they took action.
They did. They passed the hat, crowdfunded over $78,000, and hired a nationally recognized forensic investigator to find out what is actually happening with their money.
And the result of that crowdfunding is the source material we are dissecting today. It's a preliminary forensic report titled Minnesota Mirage, sleight of hand, produced by Benchmark Financial Services.
Such a great title, by the way.
It really sets the tone. The objective of this deep dive is to evaluate the report's claims regarding transparency, investment management, and structural accountability.
Right.
We're going to break down the mechanics of how these multi-billion-dollar funds operate and examine the real-world implications for the classroom teachers whose life savings are, totally at stake here.
Because it really is their entire future on the line.
Exactly. And before we dive into the data, we have to establish the parameters of this discussion. Public pensions and state politics intersect in ways that inevitably generate intense partisan debate.
Oh, for sure. It gets heated quickly.
Right. So our objective today is not to take a political stance or endorse any ideology. We are looking strictly at the financial architecture, the mathematical claims, and the documented facts presented directly in this independent forensic report.
Okay, let's unpack this. The entire catalyst for this investigation was a profound lack of visibility. I mean, the teachers just want to see the receipts for how their money was being managed.
Which is a pretty reasonable request.
You would think so. So the investigator utilized a tool available to any citizen filing a public records request under the Minnesota Government Data Practices Act.
Simple enough.
Right. They went straight to the Minnesota Teacher Retirement Association, the TRA, and asked for the fundamental investment documents. The contracts, the fee schedules, the prospectuses, basically the blueprints of where the money lives.
And what did the TRA say?
Their response was that they do not have access to or possession of those documents.
Which is structurally baffling. I mean, think about
It
it.
makes no sense.
The TRA is governed by an 8-member board of trustees. These individuals are fiduciaries, meaning they are legally obligated to act in the best financial interest of the teachers.
And part of that legal obligation is knowing what you own, right?
Exactly. Fiduciary duty legally requires you to know what you own. How can a board sign off on tens of billions of dollars if they don't possess the documents that prove where the money is actually sitting?
It sounds like a financial escape room.
That's a good way to put it.
I mean, the teachers ask the TRA for their receipts, the TRA points somewhere else, and no one can find the door.
What's fascinating here is the structural complexity that allows this accountability void to exist in the first place. The report calls it a sleight of hand.
So how does the trick work?
Well, the TRA doesn't actually hold its own assets. Instead, those assets are funneled into a massive pooling mechanism known as the combined funds. They are custodied and managed by an entirely separate entity called the Minnesota State Board of Investment, or the SBI. So when the TRA is asked for the receipts, they simply point to the SBI and say, "We don't hold the documents, they do."
Ah, so they just pass the buck.
Right. The architecture intentionally separates the fiduciaries from the actual management data. This isn't just bureaucratic red tape, it's a massive failure of fiduciary duty. Without basic documents, these boards cannot properly monitor risks or fees, making public scrutiny impossible.
And allowing potential mismanagement to just thrive in the dark.
Yeah, exactly.
And this total lack of visibility into the receipts creates an immediate problem because if the TRA doesn't have the documents, the investigator has to go to the SBI.
Right, the next logical step.
So they filed the exact same public records request with the State Board of Investment, and the SBI met the request with absolute silence.
Wow, just nothing.
Nothing. They didn't produce the documents. They didn't officially claim the documents were exempt from public record. They simply ignored the request entirely.
So we have this massive bureaucratic runaround.
Yeah, and hovering around all of this is a third board, the Investment Advisory Council, or IAC, which consists of 17 members appointed to advise the SBI.
That is a lot of cooks in the kitchen.
Right. Between the 8 TRA members, the 4 SBI members, and the 17 IAC members, you have 29 people overseeing $28 billion in teacher assets.
And yet not a single entity is willing or able to produce the actual investment contracts for public scrutiny.
It's mind-boggling. How can 3 separate oversight boards oversee tens of billions of dollars if no one admits to holding the actual investment documents?
Well, let's look closer at the composition of that 4-member SBI board, because it explains a lot about the oversight dynamics.
Okay, who's actually on it?
The board is comprised entirely of elected politicians. You've got the state auditor, the secretary of state, the attorney general, and the governor.
Wait, just politicians?
Just politicians. The report underscores a critical vulnerability in this design. There is no statutory requirement for these politicians to possess any background in finance, pensions, or institutional investment.
You're kidding?
No. In fact, the report highlights that the governor, who actually chairs this board, stated in recent financial disclosures that he has never owned a single stock or bond.
So the people holding the ultimate authority over complex, multi-billion-dollar alternative investment portfolios have potentially zero experience in financial markets.
That's what the report indicates.
And the board that does represent the teachers doesn't have access to the paperwork.
Right. It's a systemic failure. Without prospectuses, fee schedules, or consulting contracts, neither of these boards can properly monitor the risks they are taking or the fees they're paying.
Because when public money is pooled into these opaque, combined funds, it entirely insulates the asset managers from public scrutiny.
Exactly. The mechanism of pooling is exactly what shields the system. If you can't see the individual investment costs, how do you verify if the overall fund is actually generating real wealth?
Right, you're just taking their word for it.
And since the investigator couldn't access the raw investment contracts, they had to rely on the state's publicly reported performance metrics.
Okay, and what did those show?
This is where the forensic analysis reveals massive discrepancies between the stated success of the fund and the mathematical reality.
Here's where it gets really interesting. Because when you look at the TRA's publicly stated financial reports, they claim their fund outperformed its custom composite index by exactly 0.2%.
Which sounds nice on paper.
Sure, but that's not just a one-off good year. They claim they beat the benchmark by exactly 0.2% on a 1-year, 5-year, 10-year, 20-year, and 30-year basis.
Wait, the exact same margin?
Yes. A consistent 0.2% outperformance across every single time horizon. Now wait, if I'm a teacher looking at the annual report, a consistent 0.2% outperformance sounds like steady, reliable management, but you're telling me it's actually a massive red flag.
Oh, absolutely. Global markets are far too volatile for an actively managed multi-billion-dollar fund to land on that exact margin of victory across 3 decades.
It looks statistically impossible.
Because it basically is. The investigators applied probability modeling to that claim, pulling data from the SBI annual report spanning 2014 to 2023.
And what did the math say?
They calculated the odds of achieving that exact same return differential 5 separate times relative to the index. The probability comes out to 0.00000149.
That is a lot of zeros.
It is. To translate that into something tangible, those are roughly the same odds as being dealt a straight flush in a game of poker.
Oh, wow.
Yeah, it's an outcome that effectively defies the realities of market fluctuation.
So how are they generating these numbers? I mean, they aren't defying the laws of mathematics, which means the variable they are manipulating has to be the benchmark itself?
You hit the nail on the head. The operative concept here is benchmark bias.
Benchmark bias. Okay, explain that.
Industry experts, including investment consulting pioneers like Richard Dennis, have documented how public pensions frequently construct highly complex, custom benchmarks that they continuously alter.
Like moving the goalposts.
Exactly. The SBI uses a custom composite index. By shifting the goalposts, they're essentially grading their own homework.
So they can't lose.
Right. And the most glaring example is how they benchmark their private markets, which, by the way, are their highest cost, most aggressive investments.
Okay, so what do they compare those against?
Instead of comparing those private equity returns against a broad market index, the SBI actually evaluates them against the consumer price index, plus a spread.
Wait, really? The CPI?
Yes. They're comparing aggressive corporate buyouts to standard inflation.
That is insane. Comparing highly leveraged private equity to basic inflation is like racing a Formula One car against a golf cart and handing yourself a gold medal when you cross the finish line first.
That is a perfect analogy.
You are virtually guaranteed to outperform the metric, creating a massive illusion of success for the board and the public.
And if we connect this to the bigger picture, when a fund creates its own nebulous, shifting benchmark, it masks severe agency problems. By setting a remarkably low bar, the fund creates this illusion of success while potentially hiding billions in missing growth.
So how did the investigators find the truth?
They stripped away that custom composite index to see the actual financial reality. They evaluated the pension's performance against an empirically determined, risk-adjusted passive benchmark over the past 30 years.
And just so we're clear, a risk-adjusted passive benchmark represents what?
It represents what the fund would have earned if they had simply invested in standard low-cost index funds with the exact same level of risk they are currently taking.
Right. And when evaluated against an objective standard, the Mirage collapses.
Entirely.
The report calculates that the fund actually underperformed by $39 billion over that 30-year span.
$39 billion.
That is $39 billion in missing growth. That represents the core security of these teachers' retirements. Which begs the question, if the fund is trailing an objective market by that staggering of an amount, what is physically draining the capital?
Well, the capital drain points directly to the portfolio's highest cost, highest risk, and least transparent sector. Alternative investments, predominantly private equity.
Of course.
The mechanics of how these fees are extracted and reported is honestly a masterclass in financial obfuscation. State pensions widely report their returns, net of fees.
Meaning what exactly?
This means they only publish the final profit figure, intentionally withholding the gross returns.
So they're showing the board the money that arrived in the bank account, but they're completely hiding the line item that shows what the Wall Street managers skimmed off the top.
Exactly. And it is a deliberate reporting choice. The SBI's annual report contains a disclaimer stating that performance is reported after all charges to ensure the board's focus remains on true net returns.
Like they're doing them a favor by hiding the costs.
Right. The investigators argue this practice intentionally blinds the fiduciaries to the actual cost of business, treating hundreds of millions of dollars in fees as a mere distraction.
That's terrifying.
It is, because if you only look at net returns, you have no mechanism to monitor things like carried interest, which is the massive cut of the profits, usually around 20%, that private equity managers take for themselves on top of their standard management fees.
So the fiduciaries likely don't even know the total amounts being paid.
Probably not, because the system lacks transparency, exposing the pension to massive unregulated risks.
And looking at the portfolio data in this report, the impact of that blindness is obvious. There is a huge concentration of assets that have completely missed their liquidation dates.
Yeah, the zombie funds.
Right. The report identifies 45 out of 193 private equity funds held by the SBI that are past their 12-year lifespan. These are essentially zombie funds just limping along.
If we connect this to the bigger picture, the life cycle of a private equity fund is vital to understand.
Okay, lay it out first.
Generally, they operate on the 3 to 12-year timeline. The managers call the capital, buy private companies, attempt to restructure or grow them, and then sell them off to harvest the profits for the pension.
Right. Buy low, sell high.
But when they acquire mediocre, over-leveraged assets that they just cannot sell, the fund stagnates.
Sure.
By extending the life of the fund past that 12-year window, it becomes a zombie fund.
And the managers just keep collecting fees on it.
Exactly. They continue to extract annual management fees from the pension, tying up the teacher's capital in illiquid assets that are generating little to no real value.
Which brings us back to the contractor analogy we started with.
Right, the house renovation.
It's bad enough to pay fees on zombie assets that are failing to sell, but the report outlines an entirely different fee structure that is even more alarming. Fees on committed capital.
This is a huge one.
According to the financial statements, the TRA has $3.6 billion in unfunded commitments.
And this raises an important question about how capital allocation actually works in private markets.
How so?
Well, when a pension agrees to invest in a private equity fund, they don't hand over a multi-billion-dollar check on day one.
Okay.
They make a legally binding promise, a commitment to provide that capital whenever the Wall Street manager calls for it over the next several years. That is the unfunded commitment.
Got it.
However, Industry standard practice allows these managers to charge their management fee on the entire committed amount, starting immediately, regardless of whether the capital has actually been drawn or invested.
Imagine you tell a contractor you plan to spend $100,000 renovating your house over the next 10 years. They haven't swung a single hammer yet, but they charge you a 2% management fee on the whole $100,000 every single year. You'd fire them immediately. How is this allowed with public money?
It's a great question. Because what it means is the pension is paying fees on billions of dollars that are still sitting in their own bank account.
Unbelievable.
The managers haven't done any work with that specific money yet, but they are taxing it. Assuming a standard 2% management fee on that $3.6 billion, the report estimates this specific practice costs the TRA system around $72 million annually.
Literally paying Wall Street for doing nothing.
Exactly. And for the larger combined SBI pool, that waste scales to an estimated $360 million every single year.
Paying over a third of $1 billion annually for uninvested capital is just a catastrophic bleed. How are the consulting firms, the very experts hired to guide the boards, allowing this to happen?
Well, the SBI employs external investment consultants to guide their strategy. The report names 3 primary firms, Apukin, Makeda, and Alborn.
Okay.
But the forensic analysis highlights that these firms operate under significant, disclosed potential conflicts of interest.
Uh-oh.
Yeah. To understand how this drains a pension, we have to look at the difference between non-discretionary and discretionary consulting. When a firm acts as a non-discretionary consultant, their job is to provide unbiased, objective advice on which asset managers the pension should hire.
Right. They are supposed to be the independent referees.
But the conflict arises when these consulting firms also act as discretionary managers, or when they offer pay-to-play services.
Wait, what does that mean in practice?
In some cases, the consultants evaluate and recommend investment managers to the pension, but simultaneously receive compensation from those very same managers for conferences, data services, or research.
So they're getting paid by the people they are recommending.
Right. Or, as the report notes with Makeda, they act as an advisor in one capacity, but offer discretionary management themselves, giving them the power to potentially allocate capital in ways that benefit their own firm's broader business interests.
The referee is effectively playing in the game.
Exactly. And because the actual contracts aren't public, no one can verify what firewalls, if any, are actively enforced.
It's a closed loop of financial relationships operating entirely in the dark. And this isn't just theoretical risk, right? I mean, the report explicitly mentions Aon's history.
It does. It notes they entered a $190 million settlement in 2005 over allegations of fraud and anti-competitive practices.
Wow. So what does this all mean for the teacher grading papers at 9 p.m., the person who actually funded this investigation out of their own pocket?
Right, the human element.
If I'm listening to this, why should I care about a decimal point error in a benchmark? How does this actually hit the classroom?
The impact hits the classroom because pension deficits don't simply vanish. They're mathematically transferred to the contributors. When a pension underperforms by $39 billion and hides fees, the money has to come from somewhere.
Right.
The funding ratio plummets. The report notes the TRA's funded ratio has dropped to 76.9%.
Which doesn't sound great.
It's not. In the context of multi-employer plans, dropping below 80% triggers federal yellow zone status. It legally defines the system as endangered.
Endangered. That's a strong word for a retirement fund. And that 76.9% figure is highly optimistic, isn't it? Because it relies on the pension's own assumption that they will hit a 7% return rate moving forward.
Exactly. The report stresses that if you drop that expectation to a much more realistic 6%, the mathematical underfunding of the system soars to $40 billion.
$40 billion!
When the gap becomes that massive, the state has limited levers to pull, and all of them are painful.
Yeah.
This brings us to the cautionary tale from Pennsylvania, which is actually included in the report because it specifically involves Aon, the same consultant advising Minnesota.
Okay, what happened in Pennsylvania?
In 2021, an internal calculation error by the consultant falsely boosted the Pennsylvania public school pensions performance by just 0.04% over a financial quarter.
Wait, just 0.04%? A microscopic rounding error?
A microscopic error, but it pushed the stated return rate just high enough to avoid triggering a specific state law.
What law?
That law dictated that if the pension's returns fell below a certain threshold, the public school workers legally had to pay more out of their own paychecks to cover the shortfall.
Oh, no.
Yeah. When the error was eventually discovered and the true lower rate was calculated, the fallout was immediate. It forced an automatic increase in pension contributions for 100,000 public school employees.
So a mathematical miscalculation behind closed doors by an opaque consulting firm instantly reached into the bank accounts of 100,000 everyday workers.
Instantly.
It means less money for groceries, less money for rent. It proves that the technical mechanisms we were discussing, the benchmarks, the hidden fees, they directly dictate the financial survival of the workforce.
Absolutely. It directly translates to teachers being forced to pay higher portions of their paychecks into the system.
Or they suffer reduced retirement benefits. Or the state is forced to hike taxes on everyday citizens to bail out the shortfall.
Which totally contextualizes why these 2,797 Minnesota teachers are demanding sunshine. They recognize the existential threat to their livelihoods.
Of course they do.
Yet, the report details a deeply hostile administrative response to this grassroots effort.
Right, the culture issue.
When the teachers requested that the TRA and SBI simply record their public board meetings so working educators could listen after school hours, the boards refused, citing vague legal implications.
But the hostility goes beyond refusing to turn on a microphone, doesn't it?
It does. While the state officials claimed they couldn't record public meetings, internal records acquired by the investigators revealed that the TRA was secretly recording phone calls from critical teacher participants without their consent.
That is shocking.
The internal emails show administrators disparaging the very teachers they serve, labeling them as squeaky wheels. They actively mobilized a defensive network.
To do what?
Well, the documents show state officials contacting public pension organizations across the country, attempting to undermine the investigator and preemptively discredit the teachers before a single word of the forensic report was even drafted.
The velocity of that defensive response is really telling.
Definitely. One internal email from the TRA's executive director warned staff that the investigation posed many serious risks to the agency and pension fund, anticipating that their reputation as a trusted government entity was on the line.
Why would a fiduciary body, confident in its transparent and excellent management, immediately assume an independent audit would uncover something so damaging?
Right. The preemptive strike suggests an awareness of the system's profound structural vulnerabilities.
It is a remarkable sequence of events. To recap, a group of public servants sense something is structurally wrong, they pool their own money, and they expose a multi-billion-dollar sleight of hand.
A huge failure of oversight.
We're looking at a system overseen by 29 individuals across 3 boards who cannot or will not produce the receipts. We see mathematically impossible benchmarks, $39 billion in trailing performance, private equity zombie funds, and millions in fees paid for doing absolutely nothing.
All while the system quietly drifts toward endangered status.
It's heavy stuff.
It is, and we focused entirely on Minnesota today because these teachers bravely crowdfunded a look behind the curtain. But consider this, there are thousands of public pension funds across the globe managing trillions of dollars.
Trillions.
Many using the exact same opaque private equity structures and custom benchmarks. If this level of financial mirage can happen in one state's heavily audited system, you have to ask yourself, what is lurking in the shadows of the retirement fund that you are relying on?
That is a chilling thought to leave on. Thank you for joining us on this deep dive. Keep asking the hard questions and stay intensely curious about the structural mechanics of the systems designed to protect you. Because as the data shows, when it comes to the complex architecture holding your life savings, you cannot afford to let anyone else grade the homework.